As passive investors, we are all trying to figure out what is that one thing we should look at to find success in a deal. What is the one crystal clear piece of information that can tell us whether a deal is going to be successful or not? I asked one of the biggest real estate investors in the country, Brian Burke, what that one thing is that passive investors should look for, and he gave me his answer in this video right now. Brian Burke is my guest. I am Jeremy Goodrich. This is REI Clarity, and this is what he had to say. We haven't talked a ton about what a good deal looks like as compared to another deal, but is there one particular performance indicator of the deal? We talked about performance indicators of like the real estate, but when we're looking at a deal that a sponsor is presenting to us, from them to a passive investor telling us what we get for our money, what they get for their money, what the fees are, what the waterfalls are, lots of these big words. Is there anything we can boil it down to as something we should focus on as the most important?
No, and that's the worst answer I can give you, and it certainly doesn't help anyone, but it's the truth. The answer is no. There's no one single thing. Everybody wants the one easy thing, right? Yeah. So like, because you want to be able to quantify something that you can latch onto. And this is what happens in the crowdfunding space, where I was talking earlier about how you see a grid of investments, you pick the one with the highest projected return because people think that's the one thing that matters more than anything. But let me add some context to this, because the answer is a little bit more complicated than just simply no. There's three main performance indicators that you should think about. One is the rate of return, or we call it the internal rate of return, the overall rate of return of the deal. Another is the cash on cash return. And the cash on cash return is as a percentage of the amount you invested, how much do you actually get distributed on an annual basis? And then the third is the equity multiple, which means if I give you $100,000 and I get $200,000 back, that's a 2.0 equity multiple, right? So those are the three main performance indicators, and no one is necessarily immediately more important than the other. What this is it all depends on you as an investor, what you're looking for. Are you looking for growth? Are you looking for income? Which of the two? Are you looking for longer term or shorter term? Which of the two? Are you looking for high risk or low risk? Which of the two? Or maybe it's medium risk. So when you take the totality of all of these things and put them together, now it's deciding whether or not all of those metrics work in your particular situation. Let me just give you a couple quick examples. I'm a retiree. I've got a lot of cash, but I have no income. So I'm looking for something that produces a high current income. I don't need this money back if ever. My kids are going to get it, or my kids' kids are going to get it. So for that person, cash on cash return is probably the most important of the three indicators for them to focus on. Now, on the flip side, I'm a young tech exec. I've got a lot of investable assets, but I have a huge income from my W-2 job. I need a place to park my money that's better than sitting in a savings account earning nothing. So I have some capital that is, I don't care if I never see it again. My goal is to triple it. And I don't care if I lose it, I lose it. It's risk capital, that's fine. For them, looking at equity multiple might be a good measure. You know, I want to triple my money. I'm looking for a 3x multiple, and I want to do it in 5 years. That means I'm looking for a 3x multiple on a 5-year hold. On the other hand, you've got somebody that's kind of in between, and they've got good income, they've got good assets. They're just looking for the best return they can get overall. For them, IRR might be the best metric to look at because they want to get the highest return over time. Doesn't matter if it's cash flow, it doesn't matter if it's all in the back end. IRR is really important. Now, all of this has to be taken in the context of risk. And so if I am a low risk person, I don't want to invest in a ground up development deal because those are really risky. Then again, if I don't mind taking risk, I don't want to invest in a class A multifamily coupon clipper that's earning a 4% return because that's not satisfying my needs. So it's really about adjusting the risk, looking at the return, looking at your objectives, and then combining all of that together with a risk adjusted basis where you go, hey, okay, IRR is important to me. Well, here's a 14 IRR and here's a 22 IRR. Which is better? Well, the 14 might be better if it's better underwritten and it's a safer investment versus the 22 that's in inner city Detroit. It's already burned down 3 times, and and it's got over optimistic projections from the sponsor. So this is all about totality of circumstances and what fits best for you.
If you made it through that as a listener, Brian just gave us a clinic in probably 3 minutes on what every single one of us has to do as an investor on our real estate opportunities. And that is take numbers and turn them into stories. You can't just look at one number and say, this is what I'm going to look at. And when I see that, I'm done, because the story behind that number could be a whole bunch of different things. 14% IRR could be better than 22% IRR. You say, what, Brian, are you talking about? Well, he just described what he's talking about. It depends on the underwriting. It depends on the property. It depends on the story. And I think that that was so neat to hear from you, Brian. What I gained from it was that real estate takes some investment of mental capacity in a way that some other real estate opportunities generally don't as well. You have to understand what you're looking at. Well, you have to understand what you're looking at everywhere, but you really have to understand what you're looking at if you want to have success in real estate. And you have to listen to the stories that the numbers are telling. I think that's what I got from what you were saying there. Does that seem to sum it up quite about right?
You summed it up perfectly. It's all about the story the numbers are telling and what your individual needs are and which stories are a fit to your needs. And this is why I talk so much about selecting sponsors to invest with rather than deals to invest in. Because if you're just looking for deals to invest in, you're going to go for that 22% IRR. But if you're looking for people to invest with, that the guy that's projecting a 14 has rock solid projections on a low risk business model where you can know that at the end of this, at the very least, you're going to get your money back. They're probably not going to lose it. And that's more important. You can't get rich losing money. Yeah. So, it's really important to just look at that whole totality of circumstances and find the best fit for you.
Hey, Jeremy here. Thanks so much for watching this video. I hope you enjoyed it. I hope it created some clarity for you and zoomed you in on what action steps you actually need to take to succeed in real estate. If you haven't done so already, please head over to reiclarity.com and download our 9 action step framework. I believe that every real estate investor needs to take these 9 steps to succeed at the financial freedom they want to create for themselves. So if you haven't downloaded that already, please head over and get that at reiclarity.com. All right, until the next time, have a wonderful day.